Every YouTube video channel right now is telling you that the 4% rule is dead.
So we have some pretty big changes for anyone who's investing their money, the end of the 4% rule, and why we should stop using it.
They are wrong. The rule is not dead. It's one of the most validated frameworks in history of retirement planning. In this video, I'm gonna walk you through what the 4% rule actually is, and the 5 layers that high earners with 2 million or more need to add on top of it to help support the retirement their portfolio is built to provide. Let me walk you through what the 4% rule is and how it works. Really what it is it's trying to figure out what is the income that you can produce off the assets that you have invested in the market. So the 4% rule is if we were to take $1 million portfolio and we times it by 4%, we're gonna get $40,000. That's the income that you could take out of that $1 million portfolio. Layer 1, the tax bucket strategy. This is the layers where we're really gonna dive deeper than the 4% rule. After we kind of have that baseline. Really what this is it's kind of twofold. It's going to be where are you actually saving your money? Is it going to be in the 3 tax buckets? You have pre-tax, you have after-tax, and you have just basically taxable. Pre-taxed is going to be anything that's going to go into a qualified plan. So a 401k, IRA, simple IRA, something like that. Your after-tax is any Roth accounts, right? So that's going to be your 401k Roth. It could be just your traditional Roth. And then the last one is going to be taxable. So that's really your brokerage account or anything that in essence, you pay the principal that taxes on the principal that you put in, but the gains you will have to pay capital gains tax on if you were to sell any of that and move on with. So those are really the 3 tax buckets. How you use those is very important when it comes to retirement planning, because obviously there's kind of 2 things to it. One is planning for retirement and one is actually living through retirement. And so in planning for retirement, you want to make sure you're adding to all of those buckets strategically. You're adding to a little bit of the pre-tax so you can actually lower your taxes now. You're adding to after tax so that you can manage your taxes in the future. And you're also adding to the current tax or the brokerage taxable account as well, because it's going to give you the flexibility in the future. It also gives you the flexibility if you're planning to retire early before 59 and a half, so that you can actually be able to access your assets and live the lifestyle you want. Otherwise, your money might be locked up with the other qualified accounts. Layer 2, the separate healthcare bucket. Now this one is one that's probably most overlooked when it comes to financial planning. And I would say healthcare actually is one of the things that blows up a financial plan the quickest because of how much it inflates. Healthcare actually is inflating at a much higher rate than any other thing. And the fact is that even with high earners, you're going to end up having to pay anywhere between probably $12,000, $24,000 per year, even with the marketplace and the IRMAA surcharges later on. So with that, where are you going to come up with the extra funds? One of the best tools is the HSA, the health savings account. Now this account can be extremely valuable to you, and there's certain ways you can actually utilize it. So this account allows you to put away money on a pre-tax basis. It will grow tax-free, and you actually get to take it out tax-free for medical expenses. The way I like to tell people to do it, especially if you're on the healthier side of things and not having to go to the doctor, is that if you can put money away, max out your HSA for your family, for your individual self, but you're maxing it out every year, then what you want to do is, if you can, since you're a high income earner, is you actually cash flow your medical expenses that you have now. You go see the doctor, you pay out of pocket. Just pay it out of your brokerage account or pay it out of your cash flow. And what you do is you build up a nest egg for your retirement in your health account. So obviously with the HSA, you can actually have it invested. So it could be growing with the market. So you can adjust how you want to invest it based on your risk tolerance and things like that. And then when you stop earning your income in retirement, now you have a bucket that in essence is this tax-free bucket that you get to utilize for your medical expenses. So definitely try to utilize the HSA. I highly recommend maxing it out, investing it. I see a big mistake of people. They have the HSA and they forget to invest it. Layer 3, Social Security optimization. Now, a lot of people overlook this, and they definitely shouldn't be, because here's the fact. It still can offset quite a bit of income for you in the sense of money that you don't have to pull off your portfolio. So optimizing it can be extremely huge. One of the biggest strategies you can do is delaying. You can, instead of taking it at 62 and early, you can actually wait until 70, and each year is going to actually increase. So if you actually were to delay taking Social Security, taking from 62 and delaying it all the way to 70, your actual benefit can increase almost about 76%. That's a huge amount. And so really what this is that during those time frame and those years, if you were to take your Social Security later on, obviously you're going to have to pull from your assets during that time frame. And then later you can actually pull from the Social Security, and that would reduce the amount that you're going to take from your assets. So really what you want to do is make sure you're planning for it and deciding when exactly you should take Social Security, because it is a lasting impact for you for the rest of your life. You take it early, obviously you are set with a lower benefit. If you take it later, obviously you got to benefit from the increased amount. amount, but you're gonna have to fund those years before you reach 70. Layer 4. Dynamic guardrails. This one is really designed around the sequence of returns. And sequence of returns is a huge risk to any portfolio. And let me explain. You can do all the right things, and then you retire in 2008. Right? And no one really expected 2008 to be as devastating as it was when we entered it. And so when it comes to the market, it is unpredictable, right? No one has been able to predict it perfectly. We have ups, we have downs. And so when that comes to place in retirement, it can be very devastating to any portfolio. Is if we see a 2008, the market goes down 50% and you have to take out another 4% on top of it, it can be extremely devastating to that portfolio because now we have to have it come back even more. So to that extent, you kind of want to have dynamic guardrails in place. What I mean by dynamic guardrails is not so much as, oh, if the market goes down, hey, you need to spend less. And so what could you do? And so really what that is maybe you need to have a little bit of extra cash on hand, right? Maybe have a little bit of your portfolio a little safer, a little more conservative. You want to make sure the assets that you have allocated are somewhat not correlated. So if the market's moving down, it's not also moving down as well. And the other big piece is that we have a great year. The market goes up 20, 25%. Everyone's happy. And then instead of sticking with what you actually need in retirement as far as where we decided, you say, hey, I'm gonna spend a little bit more. And that's really where it can get people in trouble, is you really don't really wanna say budget, but you really wanna maintain your lifestyle, not have life creep up in retirement. Because during that 20, 25% up year, and if you only still take your 4%, the fact is now you have roughly 21% growth on your portfolio that if we were to see some big market downturn in the future, you're that much more protected. It does take a little bit of discipline and management for it, but it can have huge dividends for you and make sure that your retirement is actually peaceful and enjoyable the way you actually really designed it to be. The last layer. Layer 5, the Roth conversion. Now, when the Roth conversions are going to make the most sense is going to be during those gap years between when you retire and when RMDs or required minimum distributions happen, right? And that's either going to be 73 or 75, depending on when you were born. 75 if you're born after 1960. And here's really where it makes sense, right? Is the $5 million portfolio in a traditional IRA roughly is going to pull off an RMD of about $189,000. That required minimum distribution is going to mandate that you take out and subject to tax. Now, if you were to reduce that amount so that you can actually strategically decide when you're going to pay taxes on it, can be huge. You can decide which year in which tax bracket you actually are going to fall in. So during those years when you don't have income, is looking at your income, looking at the fact that it's no longer there, looking at what comes in, and then you're going to decide how much could you roll over. Does it allow you to stay within a lower tax bracket? Could you move $100,000, $200,000, pay taxes in a lower tax bracket so that then it won't be subject to that required minimum distribution, and it will be growing tax-free in the Roth. So really what you want to do is at the end of each year is look at what was your current income, where are you at currently right now, and then work with your tax professional, work with your financial advisor, and let them model what is it going to look like, how much tax is it going to be, are you going to be able to fall in the right tax bracket? And that is really what you want to be looking at, and that's why one of these plans is so important to really help you adjust it. So let me bring this all together. The 4% rule is not dead. It's one of the most validated framework in retirement planning history. Every major market downturn in the last 100 years has been stress tested against it, and the rule survives. The latest 2026 research from Morningstar still places the safe withdrawal rate essentially right at the rule itself. The problem is the way most people use it. They treat the rule as the complete retirement plan, when it was only meant to be the foundation. The rule delivers maybe 70% of real spending power. The 5 layers and what make it work. The tax bucket strategy that turns gross withdrawals into actual spending power. The separate healthcare bucket that protects the portfolio from rising medical costs. The Social Security optimization that helps create an inflation-adjusted income floor for life. The dynamic guardrails that protect the rule from sequential risk returns. And the Roth conversion ladder that uses the gap years to build tax-free retirement income in the decades ahead. Done correctly, the 4% rule plus the 5 layers is one of the most powerful retirement frameworks available to high earners with $2 million or more. And the catch is that none of these layers work alone. They require coordination across fiduciary CFP, a CPA, and a state attorney. If you'd like a second set of eyes on your plan, here's a link in the description to schedule a conversation. We'll look at where you stand and where the biggest opportunities are for your situation. You may already be in good shape, and that's a fine outcome. I'm a fiduciary, and there's nothing to buy on that call.